Hello everyone, Ted Bauman here. Greetings from rainy Atlanta, Georgia. It's the middle of the cricket T20 World Cup, if you know what that means. And I'm obviously wearing the shirt of my favorite team, the Proteas. And I'm wearing the hat of my third favorite team, which is the West Indies. Second favorite, that would be the Black Caps. I have a very soft spot for the Kiwis. They are just great cricketers. They play a great game of cricket, and they're nice blokes as well. Anyway, let's look at what's going on in the markets. I said yesterday to my friend and colleague Clint Lee that it's not like a roller coaster in the market. It's like a trampoline. One day up, one day down. That's exactly what we've seen. Yesterday was a pretty bad day in the market. Today has just been the absolute opposite. We've seen just some stocks just completely pop today, particularly in the semiconductor sector. More on that to come in the Bauman Letter. But fundamentally, it's just a 180-degree reversal from the way things were and yesterday. So let's look at why that's the case. Well, first of all, and this goes to show something that we all know, that the stock market and the economy are not the same thing. The precipitating factor, I think, is that gross domestic product slowed down in the third quarter. It only grew by 0.5%. Here's the chart showing that. We had 4 quarters of really strong growth going back to the last quarter of 2020, and now we've pulled back a lot. That was down from 1.6% in the second quarter, which was the biggest one other than that big tower that you see in the fourth quarter of last year. On an annualized basis, GDP rose at 2% in the third quarter. That's not good enough in terms of the history of the U.S. economy. That's kind of around where we were going before COVID, and there were hopes that we were going to be doing a lot faster than that. Overall, it was down nearly 7% in terms of growth rates from the previous quarter. Now, the big driver in the fall of GDP this month was consumer spending. Here's a chart that shows that. You can see that it was just way down compared to the previous 2 quarters. It was only 0.4% up from 2.9% in the previous quarter. Spending on goods fell sharply. Now, one of the reasons for that is not because people didn't have money to buy them or might not want to buy them, but they just can't get their hands on them. That goes back to the shipping issues. And of course, that feeds through in terms of inflation. And so people might be thinking, well, let me hold off and see if prices drop. I know that's the way my thinking is right now, that if they can clean up some of these port logjams, for example, in Long Beach and Los Angeles, perhaps we can get prices through cheaper closer to Christmas. Who knows? But that's got to have something to do with it. Of course, one of the saddest things is when business investment flows, because that's where future growth comes from. That's where jobs come from. Here's the chart showing that it slowed pretty substantially. It's declined for 5 consecutive quarters. But this is even below pre-COVID rates. You can see that in business investment slowed. And again, that probably has a lot to do with logjams. If you can't get capital equipment, if you can't get machinery, spare parts, if you can't get raw materials, you're not going to invest until you do. So that's why that's happening. Now, this is not just a U.S. problem. There's a global perception, I think, or that there's a perception that the global economy is also slowing. Here's a chart that shows the Bank of America Global Fund Managers Survey, and it's down into negative territory for the first time in 18 months. So basically, that means that more global fund managers think the economy will not improve than think it will improve, and that hasn't happened since, well, actually before COVID. And that's not good, because again, that's where investment comes from. These are the guys, they're fund managers. They place investments into the stock market, and if that's the way they think things are going to be, then they're not going to want to invest. Perversely, though, that's not been the case across the board, and I'm going to come to that in a moment. But why are we seeing this? Well, first of all, I think it's fairly obvious that the COVID Delta variant put a big crimp on consumer services spending, especially last quarter. A lot of people voluntarily went back to home and didn't go out as much and that sort of stuff. That's all understandable. But of course, as I said earlier, we've also got big issues with supply chains. Even if people have money and want to spend it, they can't spend it because the stuff isn't there or it's overpriced, and they are worried that it's going to get cheaper in future, so they don't want to spend it. Probably a good bet. But there's also another factor, and that is receding hope, I believe, for the infrastructure bill and the social spending budget bill that the President Biden has been trying desperately to get through Congress. They've put on a brave face today. I'm recording this on Thursday. Biden announced that he had a framework before he goes to Europe, but that's probably a face-saving thing, that he's saying, because if he goes to Europe without having locked down spending on renewable energy, then it's going to put a terrible dent into negotiations over the global climate change conference, which is happening, I believe, in Scotland soon. And so therefore that could make a big difference to the to the outcome, not just here in the United States, but globally. So he's trying to make it seem as though he's making progress. But I just have my doubts. I look at what's happening with they're calling them Mensch Cinema, I guess, Manchinima, Senator Manchin and Senator Sinema, both of whom don't want to sign on to the bill, but for different reasons. And trying to please both of them means that they're pulling things out of the bill that the other wing of the party, the Bernie Sanders wing, desperately wants. They're already planning to abandon paid parental leave, which puts us as one of only, I think, 4 countries in the world that don't offer some form of paid parental leave. 4 countries, folks. Even my other home country of South Africa, which is not a wealthy country, does that. We can't do it. It's sad. Anyway, but all that stuff I think is weighing on the markets. And here is a piece of evidence that shows how that's working. Here is the 10-year Treasury yield. I've taken this back on a 5-day basis. We saw a bit of a spike in the yields. They were getting up into the sort of mid 1.6, 1.7 range last week, and then last couple of trading sessions they moderated, but they stayed pretty steady. But look what's happened today. They just pulled back dramatically from about I guess it's about 1.63 or 4 down to 1.56. So that's a pretty big drop very quickly, and that means that the bond markets are reading that the U.S. economy is weakening, and that means that there's less likelihood that the Fed will be raising interest rates, at least on the long end. In other words, the 10s, the 30s, that sort of the 20s, that sort of duration of bond. And so therefore they are bidding them down. They're selling them. They don't want to be caught owning those bonds if their yields are going to fall. Now, what about the yield curve? The yield curve is known to be a predictor of where stocks might be going, where the economy might be going. Generally speaking, if it's steepening, that indicates bullishness on the economy. If it's flattening, that means that there is bearishness on the economy. Well, here's a chart I put together that shows the yield curve as it was on the 19th of this month. So in other words, it was roughly 2 weeks ago. That's the blue columns, and now where it is the orange columns. And what's interesting is that the only yields that have actually increased are the 2 and 3 year, and that indicates, I think, a belief on the part of bond markets that the Fed will probably start raising short-term interest rates, but that the bond market itself will start to push down yields on the longer-dated bonds because they believe that the economy is going to slow, and they believe that the Fed is not going to raise rates all that much. They'll probably taper their bond purchases, but they won't necessarily raise rates on longer or try to use yield curve control, which is really what the Fed does. They buy these things out of the market in order to push up their price, but they're going to stop doing that. And I believe that the market is starting to price that in. Now, I've added 2 trend lines. The trend line from 2 weeks ago showed a much steeper yield curve than today. That's the dotted orange line. So that's an indication that the bond market is beginning to price in some weakness. Now, how does that translate into the stock market? Well, here's a chart that shows the one-day action. It's basically, it covers yesterday and overnight trading and today. The red line here is IWM, which is the Russell 2000. And as I've always said, this is where I go fishing for stocks that have the potential to pop a lot because they're not in the heavily traveled and heavily covered upper tiers of the market. They're smaller and mid-cap stocks. Those are the ones that have the potential for big gains. Anyway, look what happened this morning. Just a huge spike in the IWM. The Dow was up a little bit, but not much. And that's exactly what you would expect to see happening, because if you think that the economy is going to weaken in the future, then those big industrials in the Dow, the big GEs and those GMs and those kind of companies, you're going to see weakness there. Now, that's not necessarily the case across the board, as I'll show you in a moment. There are some bright spots in the cyclical consumer economy, but generally speaking, the stock market is pricing in higher returns from small and mid caps. Now, there's another reason why they would do that, and that relates to to interest rates. If interest rates are not going to go up as much as feared, if inflation is going to abate, if we're going to see slower growth, and the Fed isn't going to raise short-term interest rates, and the bond market is probably not going to try to push them up too much more, then you could see a pop in the technology and growth stocks that have suffered so much this year because of fears of inflation and of interest rate hikes. So I believe that's part of what we're seeing today. We're starting to see another rotation. As I said, calling it a rotation, it's more like, today we happen to be up in the air as opposed to down on the trampoline because of this, this rapid shifting back and forth. And I'm going to come back to this in a moment because I want to respond to a comment that somebody made on my video from last week about the direction of the market. I want to come back to that. But what other impacts does all this have? Well, here is the U.S. dollar index, and look at that drop, man. I mean, that's a big drop. I mean, it's actually maybe not that big in the bigger picture, but if you look at it from the perspective of the last 5 days of trading, that's a big dive in the dollar, and a very steep one. And that's because two reasons. One is that if interest rates are not going to be going up, people are not going to be as interested in holding dollars because they won't get as much of a return on their investment in U.S. bonds, so the demand for bonds goes down. But it's good in the sense that it should help U.S. companies that export. If the dollar is cheaper, it helps them, and that makes them potentially more attractive. Now, of course, a lot of our exporting companies are actually technology companies who are exporting services, and that includes some of the biggest ones like Google and Alphabet and Facebook and others. And so if that happens, if we do get a weakening of the dollar and those companies bounce up, that could offset some of what we've been talking about in weakness in the Dow. Now, I promised you we'd have a closer look at the price action. Here is the S&P. When I took this snapshot this morning, was up about just about 8.8%. But the biggest gainers were consumer discretionary and healthcare. Now, in the consumer discretionary side, if you expand that, which I didn't hear, the biggest gainer was automobiles. And the reason for that, I believe, is that people are starting to see light at the end of the tunnel when it comes to semiconductor shortages. I'm bullish on semiconductors because I know a lot of money is going to be spent on increasing semiconductor manufacturing capacity in the next couple of years. And so that's a place I'm really interested in. But the knock-on effect of all that activity in semis is that you're starting to get some bounce back in automobiles because people are thinking, well, prices are going to be coming down, shortages are going to start to abate in the automobile sector. People are going to be really keen to buy cars that they couldn't buy all summer and into the fall, and therefore let's buy those stocks now so that we can get ahead of that pop in their share price. And so, the market is pricing in future expectations, and boom, there you go. Healthcare, classical defensive sector, also up today. That's natural. Financials up. Financials have been up a lot more in the last couple of weeks, and that's because when the yield curve was steepening, people thought that financial stocks would be doing better because their lending margins would improve. They'd be borrowing lower long-term rates and lending at shorter rates. What the yield curve is doing now is essentially confirming some of that. And I think fundamentally financials are still going to do well because whatever happens with Fed tapering, it is going to increase banks' margins. And we've seen some really good results from the financial sector. So that's why that's happening. Information technology, that's also the big, the FANGs, the big tech stocks that I talked about earlier, also up today, partly because of strong earnings, but also I think because of the dollar. At the bottom, energy, that's obviously going to suffer if you have a weakening economy. And then communication services, and that is really goes back to, is mainly things like, the cell networks and all that. And again, if you have a weakening economy, if you expect consumers to be a little bit more tight-fisted, they're not going to spend as much money on that, which is not really a discretionary expenditure, but it is one that can be expensive and people can cut back. Now, the big picture here is this chart shows the gross domestic product of the U.S. going back to 2015 and the trend line that we were expected to be on if COVID had not happened. And here's the critical thing, that right now we are still not back to where we would have been if COVID had never happened. And that's why I think when a lot of people talk about, supply chain issues and all that, they're underestimating the fact that there is quite a lot of slack capacity in the economy. There are a lot of people who are choosing not to go back into the labor market, but there's also a lot of business expenditure and capacity that could be brought online that isn't being brought online, and it can happen. And it would happen if the signals were right. In fact, I'm working on a quarterly report from my Bauman Letter readers that is going to show that capacity utilization in the United States is low and falling, and that there's a lot more slack in the economy than people think. And that's one reason why you shouldn't get too panicky about supply side inflation. Now, so my prediction from all of this is that in the short term, at least, if these trends don't change, if we continue to see weakness in the U.S. and the global economy, we will probably continue to see a reversion back to growth stocks. We're seeing a big jump in a lot of them today. Obviously, some of them are not because of earnings and whatnot, but generally speaking, the big gainers today are the stocks that expect to provide cash flow and earnings years to come as opposed to right now. And that's obviously the classical relationship between interest rates and those stocks. When you think interest rates are going to be low, you're prepared to pay more for earnings in the future than you would otherwise. So I think we might be seeing that. A lot of people are saying we could see strong stock market performance into the end of the year. In fact, that has been the trend in the past. In 2018, obviously it wasn't. Chairman Powell he learned some lessons about opening his yap and starting to talk about interest rate hikes in the fourth quarter of the calendar year, and the market punished him big time. That was a one-off. We could see good performance into the end of the year. I'm not sure. It's so situation-driven. It's policy-driven. It's Fed-driven. We're starting to see some of the smaller central banks around the world, like the Aussies and the Canadians, and potentially even the British, raising long-term rates in order to basically try to tamp down inflation expectations. And that could eventually feed back to the U.S. market. So that could be the December surprise, or November surprise, if you want to call it that. But right now, the way things look, it's looking fairly bullish for the stocks that were bullish this time last year. Last thing I want to mention, somebody made a comment on my video last week saying that I said that the market was directionless this year, and he pointed out, well, the Dow is up a certain percentage, the S&P is up, the Nasdaq's up. How could I say that it's directionless? Well, it's important to disaggregate. When I say that the market is directionless, I'm really talking about the small and mid caps, the Russell 2000, and again, that's where you get the big gains. That's where stocks that can come out of nowhere with a new product or a new set of analyst revisions, and all of a sudden you're up 10, 20, 30% in a couple of weeks on a stock. And those are the kind of gains that that we try to look for, particularly in services like my profit switch. We have had a couple of those that have done that for us in the last couple of weeks. And so it's starting to that strategy of mine is starting to work again. But for a lot of this year, it wasn't. So when I say the market's directionless, I should specify, and so should you, that I'm talking about primarily the Russell 2000. The big caps, the big boys, the Alphabets, the Facebooks, the Googles, the Apples, all of those stocks have lifted the market up this year. And I've always made the point that if you look at the overall index and you don't disaggregate, you can think, why the stock market's going up, why isn't everything going up? Well, that's because they have a huge weight in the market index, and so a handful of stocks had the potential to drag markets up, even when underneath the hood you're getting a lot of really. We had at one point something like 80% of stocks in the Russell 2000 had suffered a technical correction of 10% during the course of this year. That's what I mean by directional. So, as I said, make sure you go beneath the surface and make sure you watch the videos to their end, rather than just to the point where you say, I don't like what he said, so I'm going to comment now and not watch the rest of the video. I understand there's a temptation to do that, but it's never a great idea, because then I can come back and prove you wrong. Anyway, this is Ted Bauman signing off.